Motley Fool reader Terry asks, if we get QE3, and at this point we have, how should that affect REITs like Annaly Capital? Hi, I'm analyst Anand Chakavalu, and I'm going to try to field Terry's question. Terry's referring to QE3, or the Fed's plan, the recently announced plan, to try to lower long-term interest rates by buying up mortgage-backed securities. Now, he's referring to REITs like Annaly Capital. These are specifically mortgage REITs, and you might have heard names like Annaly Capital, Chimera, Hatteras Financial, American Capital Agency, and Invesco. And they're all similar in that they try to make money on the spread in interest rates. They try to borrow cheaply at short-term rates and then lend at longer-term rates by lending effectively by buying mortgage-backed securities. So they're all similar business models. And with the Fed trying to lower long-term interest rates, you can see how that could have an effect on the interest rate spread. And specifically, it'll contract, if all goes going according to plan, it'll contract the amount of spread that these companies make. And that'll lower their profitability, and it'll lower their potential to pay out dividends to shareholders, which is the big attraction to mortgage REITs. They pay out very high dividend yields compared to the rest of the market. So that's how QE3 affects it. One other thing to keep in mind is they do hold these securities on their books, so as interest rates go down, the value of those securities actually go up. But the bigger effect is the constriction of the interest rate spreads. If you ask the companies, they'd say this is probably a bad thing. But again, these are very complex entities. It's not just about the interest rate spread. They do a lot of hedging, and you really have to get comfortable with management and what they're doing on the books. These aren't the kind of companies for basic investors or beginning investors. These are for more advanced folks. But there's the answer to your question, Terry. Fool on.